Folks, welcome to episode 7 of the Taylor Tax Show. I'm Terrence Taylor, and this is my partner, Big Al. Say what's up, Big Al.
What's going on, everybody?
All right, episode 7, we want to help highly paid, highly taxed, and high-profile taxpayers learn how to save a bunch on taxes by investing in real estate. So one of the things that Big Al and I have experienced is when you are a highly paid, highly taxed taxpayer, you end up running up against a loss limitation that the IRS has when it comes to real estate. And if you've ever had this experience, you might be wondering, well, how do I get around this loss limitation? Well, this episode is going to show you how. And I'm going to kick it over to Big Al to tell us about one of the ways we can get around the loss limitation of being able to claim tax deductions when you invest in real estate. Big Al?
Definitely. And one of those ways is through the real estate professional status. Now, what Terrence is referring to is that when you invest in real estate, you're primarily investing, the IRS looks at it from one or two ways, whether it's active income or passive income, an active loss or passive loss. If it's a passive form of income, then that means that you are subject to the passive activity loss limitation rules of only $3,000 of a write-off per year. And there are a couple of ways that you could get around this, which is Terrence and I are going to talk about. And I'm starting this off with the real estate professional designation. And what this means is that the IRS has created a designation for a narrow group of individuals which will allow them to write off way more than this $3,000. But the reason for it is because they consider real estate professionals to be actively and materially participating in the business of real estate. Now, there are two primary qualifications that the IRS has, and you can look this up in publication 925 on the IRS's website, irs.gov. But more than half of the personal services performed in all trades or businesses have to be performed in real property trades or businesses. That's number one. And I listen to a lot of YouTube videos and other shows and so forth. And I'm not sure that if that's expressed enough, but that's one of the qualifications. The second qualification is that you have to perform more than 750 hours of service during the tax year. I believe that boils down to about 15 hours per week. Of course, that could be acknowledged or obtained over the weekend. Working 8 hours a day on Saturday and Sunday, which a lot of real estate, professionals do easily. However, like I said, the first qualification is that you have more than 50% of your personal services still have to go towards real estate. So if you are employed, they don't consider that personal services. So you can have a full-time job, do your 15 hours on the weekend, and as long as you hit that 750 hours mark by the end of the year and you materially participate, then you could qualify. But if you are an entrepreneur or you're outside of the full-time workforce realm, you have to make sure that you have over 50 in real estate activities. But yeah, so how about you, Terrence? What's another way of saving big on real estate, from saving big on taxes using real estate?
Yeah, Big Al. So in addition to the real estate professional or rep status, there's a code, section 469 of the Internal Revenue Code, that allows something called a short-term rental exclusion. And the short-term rental exclusion allows the activity of investing and running a rental property on a short-term basis to be classified as active. So therefore, the passive loss limitations that Big Al was talking about goes away. And Big Al, my personal experience with this is, like many people who hear about investing in real estate and having rental properties, I did that. And then I found out that once I made over 100K, the IRS allowed me only $25,000 to deduct as a loss from my rental property activities. And once I made above 150,000, even that 25,000 went away, because between 100 and 150,000, I lose 50 cents on the dollar when it comes to losses. So that by the time I get to 150, 25,000 goes away, right? So, folks, if you've had this frustration of having these losses that you could be claiming disallowed, because that's what it's called in the tax code, right? Then the short-term rental exclusion, or the STR exclusion, can allow you to get around this. How does that work exactly, Big Al? I have to materially participate in running my rental real estate activity, which means I have to make decisions that impact how the rental is managed. I have to be involved in substantially running the rental real estate. And that could be, for example, ensuring that when repairs need to be made, I'm the one who's hiring folks. The second thing I have to do is I have to participate 100 hours during the year on that particular rental property. So this is much less than the 750 hours for real estate professional or rep status. And I have to make sure that the rental on average rents out 7 days or less to different renters. So this forces me into like an Airbnb model, or in the case of my wife and I, what we decided to do was to invest in units at a boutique hotel in South Africa. And because of the nature of that hotel, we easily get people who rent on average 7 days or less during the year. So that's the short-term rental exclusion. And the beautiful thing is then we're no longer capped at 25K, at 100K of adjusted gross income. And we no longer have disallowed losses above 150K, because when you're highly paid, highly taxed, and high profile, you're much more likely to have income that's above 150K. So that's the SDR, Big Al.
You know,
So
and
Big Al, yeah, go ahead. Yeah.
one thing I wanted to mention is that I know we keep talking about losses and capturing the losses and using the losses on your tax return. And you're thinking to yourself, hey, why the huge focus on losses? We're just talking about paper losses.
Yeah.
Paper losses meaning that you might not have lost that amount in cash, but due to depreciation and how we capitalize certain things in real estate, that's the huge win when it comes to real estate and taxes is depreciation, which is a phantom expense or a paper loss.
Mhm.
Go ahead, Terry.
Actually, thanks for that, Big Al, because you reminded me that the reason folks were bringing this episode to you is because we said to you that real estate and investing in real estate can allow you to save a bunch in taxes. Well, the way you save is when you're allowed to reduce um, your adjusted gross income. And having losses, especially paper losses, is the name of the game, because by doing that, you're able then to reduce your adjusted gross income. So for example, if you were making 175K and you have losses on paper in your real estate rental business of 50K, well, if you don't have either real estate professional status or short-term rental exclusion qualification, you actually would not be allowed to even recognize 25,000 in losses. So your adjusted gross income will stay at 175. Once you qualify through real estate professional status or the short-term rental exclusion, IRC section code 469, now you're at a stage where you can take your adjusted gross income from 175 to 125. And that's where the tax saving comes from. So thanks for that, Big Al. I actually wanted to ask you, we've shared with folks how these two statuses can help them to save taxes. Can you give them some practical ideas and tactical things in terms of how to save on their taxes?
Yeah, definitely. And I won't be able to go too deep into detail, but we'd love for you to inquire more and ask us more about it. Also, this is a great opportunity for you to check out Tax Strategies GPT to ask further about some of these questions you might have about some of these other strategies, I'm pretty sure many of you all have heard of the 1031 exchange, but that's the like kind exchange, meaning that you can purchase, well, if you were to sell one of your investment properties, that you can purchase a like kind property, meaning another piece of real estate, but it has to be of equal or higher value, and invest, and I'll say quote unquote, invest your profits or your gains, your capital gains into the next property in order to avoid paying capital gains taxes on the gain of the investment property that you just sold. Now, there are rules and parameters on how quickly you must identify the next property and when the next property needs to be purchased. But once again, check out Tax Strategies GPT. Also, I'm not sure if you've heard of this, but maybe you have. Cost segregation study. So now let's just say that you sold your last investment property, you invested the gain into your next investment property, but how do you take advantage of that next investment property in order to get that money out? Now, back to this buy, borrow, die, which we talked about in our another podcast. Yeah, you can refinance it, use some of those loan proceeds, and get some of the money out that way. So there's always ways to access your cash. However, you could also do a cost segregation study, which then allows you to pretty much break down the components of the new property, especially in the renovations that you do, so that you can capture a larger amount of depreciation on the components that aren't literally going to take 27 and a half years until they need to be replaced, like an overall rental property. But that affords you sometimes up to 30 or 40% of the entire purchase price that you can immediately write off in the initial year of purchase. So that's a huge, huge benefit from a real estate standpoint, and something that some of my clients even utilize, where they might just purchase a new piece of real estate every year in order to do a cost segregation study and capture those losses. Because once again, if you've got a lot of income to defer taxes on, you got to take some pretty strong aggressive actions. Next, a management company. The thing about a management company is that, once again, our very last podcast, episode 7, we talked about owning a business being the Swiss Army knife of taxes. Now, by owning a management company, there's a certain way that you can separate the expenses of operating and investing in your real estate so that you can recognize a much larger, write-off or deduction using the management company, while the actual holding company or the company that you're holding the real estate in utilizes the depreciation. We could talk more about that at a different time, though. And then finally, I wanted to, from a practical and tactical standpoint, as Terrence was talking about, using opportunity zones, investing in opportunity zones, and actively looking for real estate in opportunity zones, which will, once again, it has certain qualifications and timeframes, but it will allow you to avoid capital gains taxes so long as you hold the property for a certain amount of years. So yeah, back to you, Terrence. What are your thoughts about what we just talked about?
Well, first of all, I'm just super excited to be able to share this knowledge with folks, because I know when I was getting into the space of investing in real estate, I found out very quickly 5-6 years ago that this 25,000 loss limitation, and then the disallowed losses kicked in, and it was very frustrating to have heard that you could use real estate but not be able to really use it. So folks, there you have it. There are 2 things that you could do to ensure that you could take real estate as it's intended to be used to reduce taxes. Qualify for real estate professional status, or qualify for the short-term rental exclusion, and then those disallowed losses and loss limitations no longer apply, and you can reduce your taxes and save a bunch on taxes with this strategy. So that's why we're here. We're trying to help you to level the tax paying field. All right, folks, thank you so much for joining us for episode 7 of the Tailored Tax Show. We'll see you soon.
Cheers.